Welcome to the Financial Feast podcast. I'm Kevin.
And I'm Zach.
And today we're going to be continuing our portfolio investment conversation by talking about rebalancing, alternative investments, and cash.
Welcome back, everybody. Glad that you were able to join us here. Obviously, we just celebrated Easter. So in light of it, maybe a little controversial, but I feel like Easter is a decent food holiday. So I wanted to ask you your rankings on the five major holidays for food. We got Easter, we got Christmas, we got Thanksgiving, obviously.
Biggest one, right?
We got New Year's, which may be a little controversial. We like pork and sauerkraut on New Year's because we're Polish, so I don't know. That's me. And then obviously you got July 4th, which is a good quality barbecue for the Americans. Right. That might be a little bit divisive also, depending on where you live, maybe. But out of those five, how you feel? Well, I mean, you just rank them. 1 through 5. Go ahead.
Right. I'd have to say Thanksgiving, first of all.
Okay.
I mean, how do you top that?
It's a quality one.
Right?
It's a quality
Thanksgiving,
one.
number one.
Okay.
Number one. Number two, I'm going to have to go Christmas. I really will, yeah, because our family doesn't do that much, like, historically with some of the other ones. Like, New Year's, we don't really do that much, honestly. So I'd have to go Thanksgiving, Christmas, July 4th, because I just love stuff on a grill.
See, that's why I thought you'd actually have July 4th in front of Christmas, because I know you like some barbecue.
Yeah, but I also like, the big meal you get with, like, it's almost like Thanksgiving 2.0 when you do Christmas. It kind of is.
It is. I mean,
it's like your excuse to do it again a month later.
It's a good one, yeah.
Yeah, so I'd have to say Thanksgiving, Christmas, July 4th. Then I'd have to go Easter.
Okay.
Because we do a pretty good meal for that too, and then New Year's because we don't really
do much for that.
No.
Have you ever had lamb? Are you a lamb person for Easter, or are you just going with the ham? Or is there a different meat? Is there a different meat for Easter? I don't know. I feel like it's either lamb or ham, but
we usually do ham.
Okay.
How about you guys?
We've always done ham.
Yeah.
I don't know.
Yeah.
I'm scared of cooking lamb. It intimidates me a little bit.
Yeah,
and I feel like when we've had it, my wife didn't love it, and I thought it was okay, so I like ham.
Yeah, don't mess with what you don't need to mess with,
for
right?
sure,
yeah.
for sure. All right, so back to what we're going to be talking about today.
Regularly scheduled programming.
So we're going to continue our conversation on portfolios here, and understanding that we've already kind of talked about what the stock market is and how to invest, and now we talked about a diversified portfolio. I think there's a couple other topics that people ask sometimes when we're talking about portfolios, and that's, what is this idea of rebalancing? Should I or should I not put my money into some alternative assets that we'll discuss outside of just the normal stocks and bonds? And then we hear the idea of having cash in our portfolio, and some people might be confused on what that is or how much it is or what it means to have cash in a portfolio. So what we wanted to do is just kind of quick run through those. So first of all, let's kind of start with what I think is probably the easiest. Rebalancing a portfolio is something that everybody should at least be familiar with.
Yeah.
When you're talking to somebody, one of your clients, about rebalancing, or maybe you're going through it and doing it for your client, how would you kind of explain the idea or concept of rebalancing?
Yeah, so I would just say rebalancing is more just kind of getting a feel for where you're at, for your age, for your investments, for your money, how much is in there, and with that, kind of make some adjustments if need be.
Yeah.
So also bearing in mind that there could be some tax implications in that as well, and kind of taking stock, so to speak, of taxes, what it looks like. Maybe there's some stuff you can do to maybe mitigate taxes a little bit. But just making sure that you're on track is what it ultimately boils down to.
Yeah, and this goes back to what we talked about last week with the idea of understanding your risks. And as you get older, your risk level changes, which is why it's important to redo your portfolio a little bit, because the assets that you may have as a younger person might not work the best as you get older.
Right, absolutely. Yeah, that's just a key thing to remember. Is something that a lot of people forget is maybe they'll put like reoccurring buys on or something like that. and then they just kind of forget to look after a couple of years.
Yeah.
That could really add up. So
Yeah.
just make sure you're checking in on it.
For sure. And then we also talked last week, pretty briefly, but we hit a little bit about the idea of putting your money into these funds that do this rebalancing for you automatically. When you're talking to somebody about doing that, first of all, what are those called? And then how do they do that rebalancing for you?
Yeah, so typically there'd be like a target fund or target date fund. So like however many years you have towards retirement, they would have that amount. So like, retirement in 2065 or 2060, and they would kind of rebalance the stock to bond ratios and all the correct stuff.
Yeah.
Right, for you.
Yeah.
So that every year it's kind of taking away a little bit more of the risk, putting into more conservative investments, and typically that's what a good fund will do.
Yeah.
Right?
Yeah.
So that's kind of what ultimately the target fund does every year, is they kind of do that rebalancing for you.
Yeah, that makes sense. So that's rebalancing. I think we pretty much hit it. We don't want to go too deep. I think that pretty much covers it pretty well. Our second topic here is alternative assets of things that we can buy, things that we can put our money into that are kind of outside of these typical stocks and bonds and mutual funds. So when we're talking about alternative assets, three of the big ones that kind of come to my mind would be real estate, which we can talk about a couple different ways that you can do into real estate.
Yeah.
There's different asset classifications called commodities that we can buy, and we'll chat about what those are. And then we can also do crypto, and we'll kind of quickly hit what that looks like for crypto, and why or why not, suspense. We are supportive of it, and if we think it's a good thing that people should buy. So first off, real estate.
No.
So when we talk about buying real estate, can you explain the difference between real estate as an alternative asset that we're talking about here, and then real estate as in the stock market in the form of a REIT?
Oh, yeah. So a REIT is just a real estate investment trust, is what REIT, or the REIT, stands for. And all that really is a conglomeration of different investment properties together, almost like an index fund or a mutual fund of a conglomeration of stocks or companies together. Yeah. So that way, if one falls off, you have the others to balance it.
Yeah.
And theoretically, it'll grow, right? Because property generally trends up, land generally trends up.
Yeah.
So the idea is that the REIT is something that you could put into if you don't have $100,000 to put onto a house.
Yeah.
Or $50,000 to put down for a house. You can put a few $1,000s into a REIT, or even a few hundred, depending on the REIT you pick, and you can slowly invest that way. And then you can still have some kind of like investment property, so to speak, if you buy it on your own, or have some cash in real estate if you do the REIT.
Okay. So, but now when we're talking about outside of a REIT investing in real estate, we're talking about now this typically bigger chunk of money to get into it, where you're getting a house. And when we're talking about buying real estate, it could just be land.
Yes.
Right? It could just be, it doesn't have to be any building on it. It could just be land. It could be personal use house as your own home that you're buying. It could be a rental property that you're buying. But both of these would be in the realm of still something that people live in. But then you could also do a corporation. You could get into more business buildings instead of just a home. So when we're talking about all these different things, understanding why these are important maybe to consider as alternative assets, I think is something that people might question. So when you're talking to your clients and you're kind of running through some of these alternative assets, why is real estate something that people should maybe, if they have the availability with finance, because it's a little bit of a larger chunk, why is it something that maybe they should look into instead of just putting it into the stock market?
Yeah, so it comes back to what we talked about in previous episodes with the importance of diversifying, right? So you want to have your money not all in one spot. So if it's not all in the stock market, or it's not all in real estate, maybe it's split between the two, then you would still have money in different places that you can kind of take from, pull from, and you're able to, at that point, kind of be more diversified, right?
Yeah.
And that's the whole point of it, is to be a little bit more diversified, not have all your money in one basket. And maybe you're better at real estate. Maybe you know what you're doing more with it.
Yeah, for sure.
And that it can be a benefit. And
Yeah.
then you can put some more stuff into it, but still be diversified with the market. And then that.
Yeah, well, and the other thing I think with real estate, especially when you're talking about rental homes, is a lot of that is a lot more passive income. Where obviously the stock market is passive income, but it's more passive income in the fact that you're getting spendable money that then you can allocate to repurposing into your real estate, buying more real estate, right? Putting it into the stock market, whatever you want to do, paying off debt, all that kind of thing. Whereas in the stock market, you might be getting dividends with some of the stocks that you're getting, but it's not going to be at the same level typically as you're going to be getting in real estate with a rental home as far as income. And generally, you're just going to reinvest that back into those stocks. So another benefit of having this real estate is additional income for you to potentially spend.
Yes, or reinvest, as you said.
Yeah,
right?
So talking about more with the not just with real estate, but then going into this alternative assets of commodities specifically. When we talk about commodities, how do we define or what does that, when we talk about a classification of commodities, what's kind of enclosed and encompassed in that?
I'd say it's almost like a raw material or something that is used to make goods.
Okay.
So that could be like metals, gold, right?
Yeah.
That's a commodity. And that's a popular one.
Yeah.
It's supposed to kind of offset the dollar. A lot of people like that as kind of a safe investment in a dollar or to counter the dollar, right? But there's other commodities that a lot of people do, like oil. But you could do agriculture. I mean, there's literally anything that goes in anything can be invested into.
Yeah, and when we're talking about purchasing these, I think there's two main ways that you can do this. I think especially when you're talking about precious metals with gold and silver, a lot of people, this is kind of growing right now where you can buy them and you can house physical gold or physical silver at your house, typically in the form of coins. You're not just going to have a chunk of gold at home, but you can have gold coins or silver coins at your house and you can have them. But then with some of these other ones, right, I'm not going to have just a 5-gallon bucket of oil sitting at my house, but there's funds that I'm able to go and purchase that are specific to agriculture or specific to natural gas or specific to oil as a means or specific to these precious metals with gold and silver that I can then purchase. That's once again the main reason that I'm doing this is to help me diversify my portfolio so that if my stocks aren't doing well, my gold might be doing really well, or my oil might be doing well, or agriculture might be doing well. And then I can kind of have this offset where maybe I need to sell something in my portfolio to help me out, and I have different assets that are performing in different ways, and it allows me the opportunity to kind of bend when the stock market kind of ebbs and flows and still deal with it.
Yeah, absolutely. So those are definitely something to consider, right? Real estate, commodities, and then there's crypto. That was such a buzzword in 2020, 2021, 2022. And, I mean, if you were to ask someone what crypto is, I would guess that about 95% of people couldn't actually tell you what it is. And, like, the number one rule of investing...
know what you're investing in.
Know what you're buying when you're investing, right? Know what you're putting your money into when you invest. So I would say crypto is still an up-and-coming thing. Who knows? The jury's still out. There is a lot of money into it right now. There really is.
Yeah.
And there could be some potential. There could not. I would not recommend people to invest with anything they couldn't lose. Yeah,
and see, that's the thing with crypto is we both know people who are in crypto and have a decent amount of crypto even. And for these people, the money that they've put into it has been money that they are willing to be, well, I'm not going to get that back, but it's kind of fun to stay on the edge and see what happens, and maybe I'll hit it big with this. Whereas when we're talking about investing our money, we're doing it for a goal of having long-term return. And that's just not something that we can really bank on with crypto right now.
It's still too new as well.
Yeah.
You don't have that history that you have with the market of, you know, you can look back in the 30s, the 40s, the 50s, and so on, and see every time there was a crash, there was a rebound, and that there's actual companies doing things on it and providing value. And with crypto, they're trying to build some stuff onto it, and maybe it'll work, maybe it won't.
Yeah.
I don't want to say it's just all like garbage, because there is some promising things into it, but it's just all too early right now.
Yeah, and honestly, if you want to buy some, we're not like totally against it.
We're not anti-crypto. We're just buyer beware.
But don't buy it as your main allocation.
Yes.
And that's your retirement plan.
Right. Don't do that.
Because it might be a good investment in 10 years. But who knows? I mean, I can pretty much guarantee you that if you put your money into the S&P 500 in 10 years, you're going to have a profit.
Yeah.
If you put the same amount of money into crypto,
you may not have anything.
Yeah, I mean, I really do. Who knows?
Yeah.
So it's something to consider, but it shouldn't be a high level when we're talking about an asset allocation. It shouldn't be a large portion of anybody's portfolio.
No, absolutely not.
Ideally. But if you want to try it, you have a little bit of fun money.
If you have extra that you're okay with losing, and you have everything already, you know, you're not doing it at the expense of your IRA or your investments or anything like that, then sure, go for it.
Yeah. So our third and final point is on cash. And I think a lot of people hear about cash in their portfolio. You watch the news, you hear investment people on TV talking about cash in a portfolio and having a certain percentage. Maybe even you have a retirement professional that you've hired that when you look at your allocation sheet, you see they have 3% of your allocations in cash. And you're like, what? I don't understand. Well, how does that work? Yeah. So we're going to kind of quickly talk about that. I think there's an important distinction that we should do between cash in a portfolio and then an emergency fund.
Yes, they are
both
different.
Important, but different things.
Right.
So can you quickly explain to us what an emergency fund is, and then we'll get into understanding what we think about cash in a portfolio.
Yeah, an emergency fund is typically 3 to 6 months of expenses that you have saved up somewhere that you can access within reasonable quickness that can provide you to get through an emergency.
So when you're talking about reasonable quickness, which is a scientific term, what would that not include?
That would not include something like a CD that has time weighted onto it, where you have to wait 6 months, a year, or 3 months to access your money. It needs to be able to be accessed within a couple business days.
Yeah. So CDs, great thing, especially now. I just read an article last night that said some CDs are going up to over 5% interest, which is incredible. It's a great idea if you want to open up a CD, but don't have your emergency fund in it, because what good is an emergency fund if I can't access it?
Yeah.
So having a high yield savings account, like we talked about a few episodes ago, that's a great option for your emergency fund.
Absolutely. Outside
of just a checking account or a savings account at your local bank, because you're going to be getting a little bit more interest, but you're going to be able to access that cash.
Right.
So that's what an emergency fund is. And when we're talking about emergency fund, it's liquid cash. That's why I brought it up, because some people get those two things confused when we're talking about having cash. Is they go, well, I have an emergency fund. Well, yes, that is cash, but that's not what we're talking about when we're talking about cash in a portfolio.
Right.
So,
and liquid, just so we know, just means it's easily accessed.
Yeah, right? good qualification. Yeah. The CD is not liquid because it has a time requirement. I can't just access the money when I want to.
Right.
So cash in a portfolio then is money that is in my portfolio that I now have the opportunity to invest with it. So I wrote down 5 quick questions that I think kind of encapsulate some of the things people think about when we're talking about cash in a portfolio, including how much, is it safe, what does it mean, what does it look like. So I'm going to ask you these questions. I would like you to kind of work through as though maybe I'm a client.
Okay.
Talking to you.
Sure.
We're gonna. I have a few questions. Give me some advice on what I should be doing with my money. And obviously, this might be different for
yes.
different clients, depending on income level, depending on debt level, depending on goal that they want to get to, all those different things.
Yes.
So these are just generalizations overall. But just a general answer, I guess, assuming that I'm a client of yours, just give me a general answer that kind of applies to the masses when we're talking about these. So question number one, we're talking about cash in a portfolio. What is the importance of cash in a portfolio? Why should people think about that? Why is it important to have cash in my portfolio?
So I would say maybe for 3 reasons. One would be short-term, mid-term investment. And then also, depending on the person, it can also be a immediate expense, meaning that you can still take it out to if you have a crippling expense. And that way you're not draining your investment portfolio. You're not draining your whole retirement fund, selling off stuff.
Okay.
You have that cash that you can access quickly. That is almost last case scenario. Last case scenario would be selling off all that stuff. This would be the next thing closer to last case.
Yeah.
But the main reason for it is that short and midterm. So when the market's really down, you have that cash that's sitting there. It's almost like a sale. Like now it's on sale. You have that cash. You have it there. And now you're able to jump on the sale because rather than throwing more money in and adding another so much money, you already have that money in there.
Yeah.
So you're able to take advantage of the moment that you have there because you planned for it.
Okay.
And that's the main reason is when you have that planning done for you, you're able to then take advantage of that moment with that planning and take advantage of the short prices and the sale price if it's on sale.
Yeah.
And then get a better rate.
And then just really quick before we go to question number 2, can you just qualify what you mean by sale price?
Yeah, so I would say sale price would be, to make it as not complicated as possible, I would just say typically a stock might trade at, the average would be somewhere between, let's say, $80 to $100. Well, if stock just got bad news and it just plummeted to 75, well, maybe the bad news is just short term. They're not going to make their quarterly results.
Yeah.
But that doesn't necessarily mean they won't make their next quarter results.
Yeah, it doesn't mean the company is in bad straits
right.
long term.
Right. It's just short term, there's a problem. Well, now you can jump on that, take advantage of that, get it at a cheaper amount, and then as it continues to go up, which hopefully it will, once again, you never know what the market will do, but this is a little added bonus that you can try and do, right? No one can time the market, but the cool thing about having that cash there is if you can take advantage of opportunities.
Yeah, when things are on sale, you have the cash sitting there and you can jump on the opportunity
right.
when it avails itself.
Yeah.
Whereas if you don't have the cash sitting there and there's a great opportunity that shows up and you're like, well, I can't do anything because I don't have anything to allocate to it.
Yes. And you don't want to sell off and buy.
Exactly. That's not what we want to do.
No.
So question number 2, directly related to this, how is this different from how is what you're explaining to us different from timing the market then? And so can you explain what we mean by timing the market and then how this would be different than timing the market?
Yeah, so it would be different because this is still coming out of your reoccurring balances. So say you're saying you want to put 10% of your paychecks, every paycheck, into this investment account. Mm-hmm. So timing the market would be, okay, instead of doing 10%, I'm going to put $5,000 in the month of April because of something I saw or read that in April this thing will be lower and this company will not be doing as well. But I am predicting because I have some source of knowledge or read something somewhere that it will do better. So I'm going to put it all then, right? That would be trying to time the market, and you don't want to do that. With the reoccurring, what you're really doing is you're still reoccurring, investing in the market with every paycheck. You're still doing that 10%. But a very small percentage of that is coming just and not buying that fund. It's just doing cash.
Yeah.
Cash. So you're still reoccurring those things, but you're not putting extra in. Therefore, when the market comes down for like a sale, so to speak, you can take that cash and then buy. But it wouldn't be so much timing the market at that point because it's not extra cash to try and pick a specific day. Yeah. If that makes sense.
No, that makes complete sense. I think that's pretty easily understood, and I think that's a good thing for people to understand because when we hear timing the market, we should think not a good strategy.
Right.
And then some people might hear this and be like, oh, well, they're telling us to time the market. And that's not the case.
No, it's not the case.
Yeah. Okay. So question number 3, can I have a storage of cash in my portfolio, or do I need to have it in a bank account and then just access it into my portfolio? So if I hire somebody, do I have cash actually sitting in my portfolio, or is it sitting in my bank account and then the person's accessing the money from my bank account? Because I think people get a little confused on, well, what does that mean to have cash like in a portfolio? Because we have the idea of a bank account that holds my money. How does a portfolio hold my money?
Yeah, so I would say with that question, it would depend probably on how they have it set up. Some companies do it differently, but generally, the more general thing is that cash would be in that portfolio, almost like the bottom of an umbrella, right? And it's just kind of sitting there at the bottom. It's going in constantly. They would not be pulling out of your checking account or your bank account to get that money. That would not be allowed. You're not allowed to do that. So what would happen is it would be kind of that recurring thing again, once again, where you're building up that cash and you're able to take that cash. But it is actually stored in that account that you have.
So there's like a specific part of the account that is specifically made to hold your cash.
Yeah. So when you see like that pie chart that says I had 4% in cash and 12% in maybe international and all that, that is all broken down. That is your portfolio.
Yeah.
But if they were to break it all down, they have that cash in a specific spot that they're able to safeguard.
Yeah.
Right? That they can pull from at those spots, but it's also there for your reasons of if you need that emergency cash and they don't have to sell off stuff.
Makes sense.
So it works for both.
Makes sense. Question number 4, directly related. Is it then, when we're talking about cash in my portfolio, is that secure? Right? Is that something that we can be confident that it's not just going to be poof, it's gone. Uh-oh, I just lost blank amount of dollars.
Yeah, that's another good question actually. So, yes, I would say it is secure because there's a lot of laws around touching other people's money, right?
Yeah.
You're not allowed to just take something out of someone's bank account and invest it for them.
Yeah.
There's a lot of checks and balances. I mean, the financial industry has a stringent checks and balance system. They also have protection for up to certain amounts of money, generally. So depending on where it is, and once again, it all depends because it depends on the company you're with, what their specific thing does, what their specific brokerage account is, and all of that other stuff. It's hard to just say in a general sweeping motion that, yes, it is. I would say that the majority of trusted ones are.
Yeah.
And there might be some out there that maybe aren't as good. And do your research is what I would say on that.
Yeah, but the big companies that you're going to mostly hear about.
Yeah, like the Vanguard.
We're not concerned
of the world
really
and,
about anything with those, with our cash.
We're not, and especially since it's only 2 to 10% maybe of your portfolio. It's not a lot.
Yeah.
So if you have $1 million, that's not really that much in the grand scheme of things.
Yeah.
But at the same time, you do want to make sure it's protected because you're trusting those people with your money.
For sure.
Yes, it is protected though.
All right. So final question, which you just hit on a little bit. How much cash should I have in my portfolio? And obviously, like we said when we kind of started this, we qualified a little bit, is the answers may vary depending on clientele.
Oh, yes.
A little bit, and circumstance and income level and debt level and blah, 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 blah. But generally speaking, kind of what have you heard? What do you encourage your clients to have as far as percentage of cash?
So the problem with cash is that it never beats inflation, right? Mm-hmm. So you don't want to have too much in there.
Can you just I know what you mean. Can you just quick explain what you mean by cash doesn't beat inflation?
So cash, say you have $1, right? Mm-hmm. Well, an inflation rate typically is 2.15% year over year. So that would mean that your dollar next year would be worth 2.15% less. Mm-hmm. So now you're in the 98.99 spot, right? But you keep doing that year over year, it's going to go down, it's going to go down, it's going to go down.
Yeah.
And you should be putting that cash to work for you and go up by investing it in different things, like different funds, different areas to maximize those dollars.
Yeah.
So you don't want to have a lot of cash in your portfolio.
Yeah.
However,
because it's not doing anything.
Right. It's not.
It's just sitting, and inflation is actively happening while it's just sitting.
Yes. So it depends on age. It depends on risk too.
Yeah.
So a higher risk, maybe you have a little less, or maybe you want to try and get the sale stuff. But once again, you might be waiting for years for the market to crash. Mm-hmm. And all that time, you could have been making money with that cash.
Yeah.
So when it all comes down to it, really is person specific to their risk, to their age, to what they are tailored for.
Yeah.
But you don't want to have that much. You really don't, because in the end, you want it to at least be doing something.
So percentage-wise, what do you say if somebody's talking to a financial advisor that they've hired, and that financial advisor is giving them percentage? What's a general good level of range for a percentage that you'd be comfortable with somebody having? Not 20%. We're not going 20%.
Yeah,
so if their financial advisor says 20%, that's
maybe
a little questionable.
Yeah, unless they're like retiring like in a month or something like that. Like once again, it's all dependent, right?
Yeah. So for the majority of people, what would be a good percentage for you'd be comfortable with?
Yeah. So typically they say 2 to 10, depending on age, risk, and all of that.
There's so much that goes into that percentage,
right?
Which is why it's difficult to give that answer.
Yeah. When it comes down to it, if you half it, around 5 isn't bad. 5 to 7, depending on age and all of that. I just personally, I don't like to have much, because I'd rather just do dollar cost averaging, which is just simply a term for the reoccurring investments. So rather than time the market and say that in April on this day you're going to put a lot of money in, you just put a little bit of money in, but consistently, and that's dollar cost averaging. So when you do that, it's a lot better results historically than trying to time it, because you can't. And then when you're doing dollar cost averaging, you want to put as much into it as you can. Therefore, you don't want as much cash. So when it comes down to it, 2 to 10% is what they say, depending on risk, depending on all of that. But I generally tend to be like 5 or lower.
Okay.
2 to 5.
Okay.
Somewhere in there.
Comfortable with a small amount, but still having it. Because when those opportunities come up and things are on sale, we want to be able to capitalize on it. So having something in there is just a wise decision.
Yes.
Having too much in there, too much of a good thing can still be a bad thing, right? Because understanding that inflation is still occurring, right? Yeah, I want to really hit the market well when it goes on sale, and I want to have 20% of my cash so I can really capitalize on it. But it takes 2 years, and all that whole time inflation's happening, and it's an issue for me long term. So kind of balancing that number is important.
Yes,
and that's why having a financial professional that you can sit down with and you can talk about those numbers, who takes out that emotion and is able to just run the numbers and look at the data and help you work out what is best for you personally, is important and helpful.
Oh, for sure. I would agree, because like you said, I mean, it's nice to hear it from someone else and from another angle, right? It's always good to get a second opinion. So, and anything, whether it's a doctor or whatever the case may be, it's usually a good idea to do that. So I would say it would apply here too.
Makes sense.
All right. So we hope that helped with, once again, we talked about kind of rebalancing portfolio, right?
Yeah.
We talked a little bit about commodities, a little bit about the different types of different alternative investments.
Yep.
And then we just talked about cash, what to think about when you're trying to keep cash in a portfolio, and what kind of goes into why you want to keep so much cash in a portfolio or not. Just the kind of thought process on that. So once again, we do thank you for listening. Follow us on financialfeastpod.com, Instagram, and Facebook, and also on YouTube, which all have the same name. So we hope to see you again.